Most traders I speak to are interested in the best speculative stock market trades in the wake of the coronavirus turmoil, but maybe the best plays are to avoid the face-ripping volatility in the financials and look to something that might be a little more logically priced, such as the grain market. Further, with the VIX posting new all-time highs, it's nearly impossible to use options to hedge stock or stock index futures speculations. We're seeing similar chaos in the oil futures markets. Because of the option blowouts, purchasing options is a really tough game, and using those options to hedge futures is a really tough game, and obviously being long or short futures can be a bit of a nightmare as well. So we're looking at corn and soybeans, and we see that they haven't really succumbed to the rash volatility that the other markets have, and as a result, there are still some low-risk plays and potentially attractive prospects. In theory, the Fed's recent monetary policies should help agricultural commodities. We like to remind traders commodity prices tend to be tied to the currency markets. As the value of the dollar goes up, commodity prices tend to go down and vice versa. Although we're seeing massive two-side volatility in the currency markets, as traders are wrestling with the premise of the U.S. dollar being a safe haven currency and the fact that it will no longer enjoy a steep interest rate differential due to recent actions by the Fed. The last time that the Fed rate was near zero, the dollar was trading in the high 80s. A return to that level, which was seen in 2017 and 2018, would dramatically benefit commodities across the board. The currency support offered to the grain markets, as well as oil, natural gas, and others, can occur regardless of supply and demand fundamentals. In addition to the potential benefit of a weaker dollar at the hands of lower interest rates, the Fed's pledge to gear up quantitative easing programs or simply increase the money supply has historically led to inflated asset prices. Corn and soybeans were recipients of the QE asset inflation after the financial crisis, and they could be again. A few other things in the ag markets that we're noting is sentiment is overly bearish. Only 26% of traders polled by the Bullish Sentiment Index were bullish in corn. Usually when you get trade sentiment to be one-sided like this, it's generally a contrarian indicator. Also, agricultural seasonality could come into play. Corn and soybeans tend to find seasonal support in late March or early April as we go into planting season. So with that in mind, there's a good chance that the downside in corn and soybeans are limited, but the upside is potentially unlimited, of course. In an environment being shaped by fear of a pandemic, rational price discovery isn't always guaranteed, even in the grain markets who are behaving a little more rationally. That said, we like the idea of limited risk, low risk speculations. A corn trader might be looking to put on bullish spreads, such as going long futures and buying cheap put options to protect those, basically putting a floor under risk. In soybeans, the options are incredibly cheap. In fact, this is about the cheapest I've seen call options in soybeans maybe ever, or at least years. So there's probably some good opportunities there. No guarantees, but again, if you keep your risk low and light, might be a good idea. In a nutshell, the market apocalypse has caused a lot of pain for a lot of people, but it's probably created some opportunities as well. Perhaps it's worth looking at the grain markets, which I think might end up being sleepers.